Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, November 30th, 2016. We had about $1.4 billion enter the conventional fund business, but the headline numbers are quite misleading. We'll get down to the details in just a second. We basically started out with strong record highs. I mean, NASDAQ, the Russell on Friday. This is after Thanksgiving holiday, basically hit net new highs. We saw that the ADP numbers came in stronger than had been expected. So private sector was actually adding jobs, and of course we heard at the end of the flows week that the OPEC actually came up with a deal to reduce the output for oil, and that was considered kind of a big plus, at least for oil prices and the like. However, investors were still concerned about what's going on in the economy, and also taking a look at possibly an overextended market, and also the probability of having rate hikes here in the near future. So I think people were kind of caught off guard a little bit about the OPEC deal, so it really didn't play through the cards, but investors remained a little bit on the concern side, a little bit on the dour side as far as flows went. So let's take a look how flows panned out for our macro groups. If we take a look at equity funds, they lost about $3 billion from that group. Taxable bond funds, $4.1 billion flew out of their coffers. We actually had muni bond funds lose $2.1 billion. Third consecutive week we've seen really big numbers come out of muni bond funds. And the only shining star was money market funds, taking about $10.6 billion. This is the reason I said that we really had some misleading headline numbers with an inflow of $1.4 billion. Well, let's take a look now at the equity group to see how everything panned out when we get into the details that I was talking about. First of all, equity funds had a minor loss for the week. Again, we had some pretty good numbers. But Wednesday to Wednesday was down 0.09%, so really almost a fraction of a point as far as losses go. It's the first week in four, though, that we've seen a negative performance from this group. And how this basically panned out into flows, we saw $3 billion flow out of the group. This is the 38th consecutive week we've seen outflows. And if we look in detail at where the groups got kind of hit the worst, domestic equity funds once again took it on the chin, $1.8 billion out. It's the 43rd consecutive week we've seen outflows out of domestic equity funds. Obviously, investors are pretty dour on that situation. They were down for about 0.30%, so really not much to talk about. But on the non-domestic equity side, if we take a look at it, they saw for the second consecutive week outflows, but to the tune of $1.2 billion, still quite a bit, although they had a positive return of 0.37%. If we break this down into detail, though, and we're taking a look at the other areas, large cap funds were the prior. They've been for such a long time. $1.3 billion this week is in outflows, and international equity funds took it on the chin as well, out about $800 million from that group. Well, let's see how this all now panned over to the equity ETF arena. There was a whole different story. I've been talking about this tale of two cities for quite some time, and it continues on. Eighth consecutive week, we've seen inflows about $2 billion this week. iShares corporate S&P 500 ETF saw $841 million net new money coming to their coffers, and the First Trust Industrial Producers Durable Goods Alpha Dex ETF, boy, that's a mouthful, saw about $740 million net new money coming to that group. On the bottom of this, though, we saw First Trust Consumer Staples Alpha Dex ETF lose about $707, and Spider S&P 500 lost about $617 million as well. So really a tale of two cities. You see outflows out for the retail investor. Authorized participants seem to continue to put money back to work. Got to be some storyline there. Well, let's turn our attention now to the fixed income universe and see what happened in that group. Fixed income funds for the fifth consecutive week saw outflows, about $4.1 billion this week. It's the first week in six, though. They've had positive returns, 0.18%. If we take a look at the only inflow of the group, it came to corporate high-quality funds. They only saw about $41 million. That was it. And then we take a look at the big pariah for the fourth week in five. We're looking at corporate investment-grade debt funds taking it on the chin, $1.5 billion in outflows from that group. Let's take a look at the ETF side of the fixed income universe to see what happened in flows in that case. We've got $1.1 billion in net new money coming into the group as a whole for ETFs. Again, that dichotomy we have, retail investors getting rid of money, For obvious reasons, they're afraid of what the Fed's going to do. They're afraid about inflation. But we've got authorized participants putting money back to work, and this is the second consecutive week they've seen inflows. At the top of the group, we saw the Spider Barkley High Yield Bond Fund taking about $522 million. And then we saw the Spider iShares iBox High Yield Fund, Corporate Bond Fund, actually an ETF, actually taking about $487 million. And at the bottom of the group, we see the iShares 7 to 10 Treasury Bond Fund ETF lose about $222 million. Well, that makes sense to us, right? You know, we've had basically a pretty big increase. I think as of the 30th of November, the 10-year Treasury was right around 2.37. We haven't seen that since probably somewhere in about July of last year. And so really we're at a really high interest rate for treasuries, and we have fears of inflation. So we've been seeing, you know, a lot of ETFs and also retail investors putting money to work back in our loan participation funds and also in our inflation protected bond fund group as well. So that's been money going there, but again, a little bit of a head turner when you take a look and see ETF investors on the fixed income side putting money back to work. Well, let's take a look at muni bond funds. They got creamed again. Basically, they saw about $2.1 billion in outflows, third consecutive week that they've seen, again, double digit, when I say double digit, in the billions, in this case, $2.1 billion in outflows. And it's the fourth consecutive week they've seen negative returns this week to the tune of 0.49%. That's a pretty big loss if you consider this a weekly flow or a weekly return, and also on a muni bond fund as a whole. National munis saw the biggest outflow, about $1.8 billion, and this is the third consecutive week that they've seen outflows. So really we've had some change of pace of how investors are perceiving, definitely getting rid of govies in most cases, treasuries, govies, and also munis. That seems to be the pariah of the fixed income universe. Let's take a look at what happened on the money market funds, the only place we saw positive flows, third consecutive week. Now we saw $10.6 billion come in this week. How it broke out: taxable money market funds saw about $10.9 billion, and then we saw on the tax-exempt money market side a continuation of outflows. This is again kind of that tax-exempt issue, interest rates rising, people kind of just getting out of the way, $296 million in outflows. But if we take a look and break this out for the taxable side, we saw the institutional money taking about $12.9 billion, while the retail investor pulled out about $2 billion. So that's where we got the net of $10.6 billion. Well, you know, everybody heard about it today, basically that we saw the unemployment rate drop to 4.6%, and now there's investors obviously thinking, wow, there's discouraged investors. You don't go up from 5% down to 4.6% without having discouraged, not investors, but discouraged employees, you know, or soon-to-be employees basically just giving up. And I think a lot of people are going to play this game. And we saw, you know, healthy 178,000 net new jobs come into this. So for November, that's a good, strong number. It's not in the 200s like we were seeing before, but good, strong number. Probably enough to get the Fed to continue on with their rate hikes. But again, this may be something a little bit choppy for the equity markets and the fixed income markets as we come in the next week or two. Investors are going to have to evaluate whether, in fact, it is a discouraged market out there and people just aren't applying for jobs anymore. Well, you'll be able to find out a little bit more about that when you can visit us next week. But if you want to do a deeper dive into areas that I did not cover today, you can go to www.lipperusfundflows.com, or again, join us next week where one of our analysts will talk about the flows of the week and what got us there. Thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.